The financial pitfalls that arise when your wealth grows. Introduction. Money doesn't come with an instruction manual. Accumulating wealth is a dream for many people. Who wouldn't want to see their bank account grow, their investments yield returns, and feel that security that the future is guaranteed? But here's a truth that few people talk about. The more money you have, the more pitfalls appear along the way. It's as if the game gets harder as you level up. The problem is that there's no instruction manual for dealing with this. What exists are stories of people who have already gone through these situations and learned, often in the most painful way possible. In this text, we'll talk about the main financial pitfalls that arise when your wealth starts to grow. It's not technical talk full of complicated jargon. It's a direct conversation, as if we were having coffee and I were telling you the most common mistakes I see people make. I'll use practical examples, everyday expressions, and simple comparisons, because money is serious business, but it doesn't have to be complicated. Shall we begin? Trap 1. Overconcentration, putting all your eggs in one basket. Imagine you have a $100,000 investment portfolio. Sounds great, right? Now imagine that half of that amount is in the stock of a single company, say, Google. It seems smart to bet on a tech giant, right? Wrong. This is what we call overconcentration, putting all your eggs in one basket. The problem is that when you do this, your financial stability becomes totally dependent on the performance of a single company. If it does well, you smile. If it does poorly, you cry. Just remember Intel during the dot-com bubble. Its stock reached $65 at its peak, but never returned to that level, even with the boom in artificial intelligence. Meanwhile, the S&P 500 index multiplied fivefold. Those who were concentrated only on Intel missed a gigantic growth opportunity. In addition to financial risk, there is emotional risk. When you put too much money into a single stock, you create an emotional dependency. You start following every news story, every rumor, every quarterly earnings report as if it were a soap opera. This takes away your objectivity and makes you make irrational decisions. That's why portfolio managers recommend that no single stock should represent more than 5% to 10% of your portfolio. Diversification isn't just a nice word, it's a survival strategy. Trap 2. Lifestyle inflation. The boat rises with the tide. Now let's talk about a silent enemy, lifestyle inflation. In simple terms, it's when your income increases and, without realizing it, your expenses increase along with it. It's like the saying, the boat rises with the tide. You earn more, but you also spend more, and in the end, you still don't accumulate wealth. A Goldman Sachs study showed that even people who earn more than $300,000 a year still live in the red. Surprising, isn't it? Among those who earn more than $500,000 annually, 40% are still trapped in this cycle. This shows that no matter how much you earn, if you don't control your spending habits, you'll never feel like you have enough money. The secret is to maintain a relatively simple lifestyle, even when your income grows. The classic book, The Millionaire Next Door, shows that the most successful wealthy people are precisely those who don't change their spending habits just because they started earning more. They resist the temptation to show off their status and prefer to accumulate wealth quietly. The truth is that meaningful experiences, traveling, learning something new, spending time with loved ones, bring much more satisfaction than accumulating material possessions. So, the next time you get a raise or a promotion, think twice before getting into the comparison game. Showing off money through lifestyle may seem fun, but in the long run it's a trap. Trap 3. Tax inefficiency. If you don't plan, the government plans for you. Few people like to talk about taxes, but they are one of the biggest expenses you will have in life. If you don't plan your taxes strategically, you'll lose a significant amount of money without even realizing it. It's like leaving the door open for the government to come in and take a bigger slice of your pie. A common mistake is putting high dividend stocks into taxable accounts instead of tax-advantaged accounts like IRAs or Roth IRAs. When you do this, you have to pay taxes every time you receive a dividend. This is simply inefficient. Another mistake is not taking advantage of so-called tax loss harvesting, which is selling loss-making assets to offset realized gains and reduce your tax bill. There are proactive ways to reduce your tax liability. Contribute to accounts like 401 Burmese Chats, IRAs, or HSAs. One of them is holding stocks for more than a year to qualify for long-term tax rates. Another is holding stocks for more than a year to qualify for long-term tax rates. The important thing is to understand that the tax office will always take a portion of your profit. Your job is to ensure that this portion is not larger than it should be. Trap 4. Laziness in refinancing. Easy money you leave on the table. Many people lose money simply because they are too lazy to refinance loans when interest rates fall. Let's look at a practical example. You have a $400,000 mortgage with a 7% interest rate. If you can refinance to 6%, your monthly payment drops from $2,606 to $2,398. That means a saving of $263 per month. Seems like little. Multiply by years and see the size of the difference. Of course, refinancing has costs, usually between 2% and 3% of the loan amount. But if you intend to stay in the house for 5 to 7 years, this saving compensates. The problem is that many people don't do the math and continue paying high interest rates out of sheer inertia. This applies not only to mortgages, but also to car loans and other loans. If you're stuck in high 2023 or 2024 interest rates, it might be time to review your options. Trap 5. Overworking. Money buys comfort, but doesn't buy time. Here's a trap that doesn't directly involve money, but something even more valuable: time. Many people, in their quest to accumulate wealth, end up working too much. The problem is that, as their wealth grows, the value of their time begins to exceed the value of their work. Imagine you have a $5 million portfolio and get a conservative 5% annual return. That means $250,000 a year, or $684 a day, without lifting a finger. In this scenario, working one more hour might yield less return than simply letting your money work for you. What happens is that many successful people become workaholics and continue working non-stop, even when they could already live comfortably. The biggest regret of many people on their deathbed is having worked too much and not having enjoyed life. Money buys comfort, but it doesn't buy time. If your income and assets are growing, perhaps it's time to review your workload and ensure you're truly living. Trap 6. Overconfidence from early success. Luck is not strategy. Successful early on can be dangerous. This generates exaggerated confidence that can lead to risky decisions. I know people who started investing in 10 stocks and had great results in 2023 and 2024. The problem is that, after that, they thought they were invincible and reduced their portfolio to just 5 stocks, started using options and even credit margin. Result: they lost more than 30% in a single year, while the S&P 500 fell only 2%. The lesson here is simple: a few lucky years don't make you an investment master. The market is unpredictable, and when it crashes violently, those who thought themselves invincible feel the deepest pain. Statistics show that up to 90% of short-term traders end up losing money. Luck is not strategy. Humility and discipline are. Trap 7. Risk complexity. Money spread across 1,000 drawers. As your wealth grows, your investments can become too complex. You open multiple brokerage accounts, multiple bank accounts, invest in startups, real estate, private funds. Suddenly, your money is spread across 1,000 drawers, and you lose sight of the big picture. This creates blind spots, makes control difficult, and increases the risk of errors. Many people pretend to understand large investments, but in practice they don't. That's why, when your portfolio reaches a certain size, the asset structure, risks, and costs